Hello everyone. I will continue with the remaining part of Chapter 8 in this lecture. So we look at different stock valuation models, different formulas which we can use to value a company and find the intrinsic value of the stock. So the first one is dividend valuation model. The dividend valuation model uh, looks at the dividend paid by the company, and based on that, it tries to find the intrinsic value of its stock. So there are three versions: zero growth model, which means the dividends do not grow in future. Constant growth rate, dividends are assumed to grow at a constant rate in future. And variable growth model. So the dividends grow at a high rate for the first few years, and then they grow at a stable, constant rate over the remaining years. So we look at each of these versions in more detail. So zero growth model means the dividends don't grow over time. So the formula is share price equal to annual dividends by required rate of return. Then we look at constant growth model. So in this case, we assume that the dividends grow at a consistent rate in future. So the share price is next year's dividend divided by required rate of return minus the dividend growth rate. So this formula is more relevant for large cap or mature mid cap companies. So they have a predictable dividend payout policies and also a predictable growth rate in earnings and dividends. So that helps us to apply the model and get a realistic estimate of the intrinsic value. So how do we get the constant growth rate? So we look at the historical data and we try to find the growth rate. And we assume that a similar growth rate will persist in future years. Then we look at the variable growth dividend model. So in this case, we expect a high growth rate for the first few years, and then we expect a stable growth rate over the remaining years. So we discount the dividends paid during the high growth rate period to their present value. We also find the stock price at the end of high growth rate period. Then we discount that stock price to the present value, and we add the two present values to get the intrinsic value. So maybe the first few years we have high growth rate and then stable growth rate after that. So annual dividend during the initial period, present value of those dividends, then stock price at the end of high growth rate period, present value of stock price, then adding the two present values together. So here is an example. So we are in 2018 and we are trying to estimate the intrinsic value. So we assume that 2019, 2020 and 2021, there will be higher dividend payouts, or the growth of dividends will be high. And after that, we can expect a constant 3% annual growth rate of dividends. So we find the present value of the initial 3 dividends. Then we find the stock price at the end of 2021. So for that, we use the constant rate growth model to find the stock price. And we get the stock price at the end of 2021. We discount that stock price to its present value. We add the two present values of initial few years dividend and present value of the stock price in future. And we get the intrinsic value of this. So finding the dividend growth rate is difficult. And if we look at the historical data of dividend payout, we may not get a very good estimate of the future trends. Instead, we use this formula. We look at the rate of return and we look at the retention rate. Retention rate is 1 minus dividend payout rate. We use these two variables to find a more realistic estimate for the dividend growth rate. Other models or stock valuation is the free cash flow to equity method and the PE approach. So we look at each of these valuation models in more details. So what is free cash flow to equity method? In this case, we find the cash flow generated for shareholders, and then we discount it to their present value, divided by the outstanding shares, and we get the intrinsic value of the stock. So what is free cash flow for shareholders? We get the net profit. We add back non-cash expenses such as depreciation, and we subtract cash outflows that happens for working capital or for uh, acquiring fixed assets. So once we have the free cash flow, we use a similar approach as in dividend valuation model. So we can assume zero growth in free cash flow, we can assume constant growth in free cash flow, or we can assume variable growth, that is high growth for the first few years and stable growth over the remaining period in future. And we use similar formula for each of these valuation models. So the alternate approach to this free cash flow method is to find the IRR. So far, our discussion was about finding the intrinsic value of the stock. Now what we do is we take the market price or take the current stock price and we try to find the expected rate of return. So we find the IRR given the market price. So in this case, what we do, we have the cash flow and we have the cash flow, we have the market price as the present value. And we do a trial and error method to find the discount rate, which makes the present value of company's future cash flow equal to the current market price. Once we have that discount rate, it is the internal rate of return. We compare the IRR with the expected return given the risk levels of the company. So now we are comparing expected return versus the IRR, and that will also help us to decide on the investment criteria. The third variant of valuation models is the PE approach. So this is more prevalent among the security analysts who cover different companies and give their estimates on the company's stock price. So we know the EPS and the security analyst also forecast the EPS for the next year. They also forecast the P ratio for the next year. Based on that, we can calculate the stock price. So there are variants of the P approach, that is price to cash flow, price to sales, and price to book value method. And all of these methods depend on the expertise of the analyst who gives the forecast for earnings per share or cash flow, sales, book value, as well as price multiples. So price to cash flow approach is an alternative for this is important for investors who believe that cash flow is a better is a better indicator of the company's true value than its earnings. So in this case, we have the price by cash flow ratio. We also have the cash flow per share, and that helps us to find the market price of the stock. For some companies, especially startups or newly formed companies, they may not have any earnings. Their cash flow may also be very volatile. So in this case, price to sales and price to book value ratios are used. That gives us a better idea of the stock price, especially the stock price in the next year. So the PE approach is used by many analysts to get the next year's estimates. So that's all for chapter 8. I'll stop here. Thank you.